Hey, John, I get calls pretty often. Hey, I inherited money. What do I do? In this episode of Friends Talk Financial Planning, we're going to talk about what we tell people when they tell us they inherited money. Hi, I'm Bridget Sullivan-Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shear. I've got a fee-only financial planning practice in Middleton, Wisconsin. And before we jump into what to do when you inherit money, I want to just remind everybody, hit that subscribe button, help other people find this information on YouTube and help us grow our channel. And with that, I'm looking forward to jumping in. We said what to do. I thought, great big party. That sounds like fun, right? I get money. Here's what we can do,
Book the Concord, right?
Yeah, right. But one of the things when you inherit, a lot of times we'll talk about, hey, money is money. Where's the best place to take it from? Which is true. But especially when you inherit money, there's kind of three flavors, right, of what things you inherit. We've got IRA-based things, 401ks, 403bs, those sorts of things. And then we've got Roth IRAs and Roth 401ks. And then we've got stuff that's not in either of those two accounts. That's just generically like regular taxable stuff. So I think about those three buckets, and there's different ways to talk about this. And I think the most complicated one is kind of the regular IRA stuff. But so when I inherited a 401k from my mom, like what do you say? What are the first sort of steps you walk people through?
Well, I tell people if they inherit an IRA or a 401k or anything that has not been taxed before, then it hasn't been taxed before, and therefore you're going to be including it in your taxes when you take the money. So you want to be smart about it, okay? And there's going to be some requirements, and you want to look up those requirements, whatever they are. There's going to be requirements, and they've been changing a lot, and even then there's a lot of pushback. And so what are these requirements? So you either want to look it up or talk to your tax advisor, but you're going to need to take some money out periodically, okay? The other thing is that in the vast majority of cases, the most advantageous thing for you to do is to break it up over that time period and take it up. You have to generally take things out in 10 years, just take it out equally over the 10 years. That's what I generally recommend for people. And if you want to pay off your house or something, okay, great, do it in over 10 years. And don't try to do it all at once, because it's going to hit your taxes. And so let's say you have $100,000 inheritance. Increasing your income by $10,000 a year probably isn't going to affect your taxes that much. But if you increase it by $100,000 a year, all of a sudden you look like a rich person for a year. And then that's not because you're booking the Concord. It's just because you got this one-off. And so if you take it all in 1 year, you're again, depending on the amounts, if it's $10,000, it's not going to make that big of a difference. But if it's $100,000, it's going to impact taxes. And who needs that?
Yeah. And that's the one thing that's so, and it feels different, right? When I save money in my 401k or other places, I don't look at that sort of like found money, and suddenly I get an inheritance and I go, oh, look, and legitimately, you just talk about paying off a house, paying off credit card. Like there's things I can do with this, but I got to step back and go, hang on a second. What are the tax consequences? Oh yeah, this 401k stuff, that all adds to taxable income. I got to be really thoughtful about how I do that, look up the rules, and then kind of figure out what makes sense for me. It's not free money that I can just write a check on because the tax bill is going to come due at some point in time on that, right?
Right, absolutely. And so then the next flavor that we're talking about is Roth IRAs and Roth 401ks. Now, those are tax-free. So you can, when you take the money out, you're not going to have to pay tax on those, okay? Which is great. And you will have to take those out over the course of 10 years, generally. In that case, that would be the last money that I take out, because you want it to be able to grow tax-free again, because it's all going to be tax-free when you take the money out. What are your thoughts?
Yeah, no, that's, these two things. Hey, I inherited an IRA. Well, it kind of depends, right? All the language sounds the same. And on the one hand, it's sort of a, not tax time bomb, but I got to think about the taxes. On the other hand, there's no taxes, and that sounds awesome, But I agree with you. Like, yeah, but how much more can I compound this tax-free growth sort of thing in the Roth? So it's tax-free, but at the same time, I still have to think about it, right? And just make a smart decision for my particular situation.
Yeah, so if you're not familiar with Roth, all those earnings are going to be tax free. So it can earn money for 10, for 9 or 10 years or however long you keep it in there. And again, when you take it out, that's going to be taxable. Our third flavor is what we in the industry call a taxable account. So that's basically process of elimination. It's not one of the other two.
Right.
Right. And so usually you get these from if you bank accounts that you inherit, or a lot of people save money the old fashioned way. They just have stocks at a custodian, like, so they just have a stock account at Schwab, or now you have to be careful because it could be an IRA or 401k. So you got to look at the title.
Right.
You have to look at the document and see how it's titled. But a lot of people just have stocks, etc., at 401k. Also, if you inherit real estate, eventually I'm going to assume that it gets sold, or even if it's not sold, it's of this type. Okay.
Yeah.
So the tax rules around this apply. And the basic rules are that whatever it was worth on the date of death is what it's worth to you. Okay.
Mhm.
And more technical than you ever want to hear from me, but that's what's going to be called the basis. So you get what's called a step up in basis, because it goes from whatever the other person bought to you. And so this could be Apple stock that they bought for $1 and now you got it and it's $1,000. And so all of that capital gain is tax free, which is great. And you get your basis is whatever the value of it is when you inherited it. And that is true for stocks, but it's also true for real estate too. So if you inherit a house, whatever the house is worth when you inherit it is what is going to matter when you go ahead and sell it, or if you go ahead and sell it.
Yeah.
Do you have anything to add there?
Yeah, no, just a couple things I wanted to pull out. I thought it was really, really a key point, and something that we maybe take for granted. But when somebody, hey, I inherited some money. What'd you inherit? Oh, just some stocks and mutual funds. Well, it depends, right? Stocks and mutual funds can live inside of an IRA. Hey, there's some different tax consequences. They can live inside of a Roth IRA. I can have stocks and or mutual funds inside of those. Right? I can have it in this taxable brokerage account. So just knowing what the underlying investment is doesn't really tell you what that tax consequence is. So you have to dig just a little bit deeper. And I think you said, and which I agree, look at what does the title on the account say? What does it say when it shows up on the statement? All right, that tells you, because you can have those same things inside three very different accounts from a tax standpoint. Um, so I thought that was a really great point you brought up. And then the other thing, just in thinking about those three different categories and how to think about them, and this basis stuff is complicated, but you kind of got to know that, hey, I get this. It's called that step up in basis. You got to know it exists so you can talk with your tax and investment people about it. But then if you leave money in that regular taxable account, stocks, mutual funds, bonds, whatever, if that continues to grow from after you inherit it, then when you sell it, there's going to be some taxes that you have to pay when you sell on the future growth. And you don't need to know the details or understand exactly, other than just in your head is on that taxable money, future growth, there's going to be some tax consequences.
Right,
Roth IRA money, future growth, no tax consequences. IRA money, tax consequences no matter what.
right.
So when we talk, I mean, one of the things like, hey, if somebody's got some credit card debt or wants to pay off their house, if I just inherited an IRA or a 401k, well, that's one, I got to think about those rules we just described, but I got to, dig into that. What happens when I inherited some, an IRA from my dad, and I inherited a Roth IRA and some regular taxable money? Now I've got some different choices. I got to think about all those things and then make the best decision as far as where to spend money to pay off my credit card, let's say, or pay for my son's college or that sort of thing. And oftentimes, just to kind of, frame it, is oftentimes that taxable money, real estate that went up and we sold, or a mutual fund portfolio that's not inside of an IRA, that oftentimes is the best place to start from a spending standpoint. Right? Again, you got to look at all these things, but that's one of those like, oh, that's something I think we should look at when we need to spend money on things because of the way that it works from a tax standpoint.
Right, so we're saying if you had all three, you'd probably and you had some immediate spending that you wanted to do, you'd probably use a taxable account first, the Roth account second, and then try to delay taking the IRA account until, so that it's equal over time. Although if you had big credit card bills at a high interest rate, it might be worth it.
Right, right. And again, you just have to balance. I think that's maybe one of the big takeaways. You have to balance these three different things, right? There's no one answer to what's the right thing is, we've got some of these, spread out these distributions on an IRA. If I decide, hey, I'm going to take out $10,000 a year from this IRA, well, maybe that's a place to start with paying off some of the debt, right? And then I go, geez, I got a big, I got a lot of, I want to pay my whole mortgage off. Well, maybe that brokerage account, that taxable money is the next place. If I want to take out 100,000, geez, maybe I don't want to take it from the IRA because then I look rich to the government, right? But I take it out of the brokerage account and then it's the same amount of money, but I look less rich from a tax standpoint, right? So it's those sorts of things to know that these different things exist and then to be intentional about making those decisions, I think is a really great takeaway.
Yeah, and we want to just mention another thing to be cognizant of if you inherit money. And that is that money gets inherited on an individual basis. And so that if you were part of a couple and you're married, it's not part of marital property and you want to keep it individual.
Yeah, yeah. Inherit, that's a great.
You don't share it with the other person. You don't give them any money or anything like that, but it's in your account and don't take marital money and put it in there.
Yeah, yeah, that's a great thing. And we recommend, I've done it myself. When we inherit money, we keep it in a separate, just because you can't undo it after the fact, right? That's the sort of thing. That's great.
Yeah. So you want to be careful about that.
Yeah, great. Hey,
I'm Bridget Sullivan Mermel. I've got a fee-only financial planning practice in Chicago, Illinois.
and I'm John Shear. I've got a fee-only financial planning practice in Middleton, Wisconsin. Both Bridget and I are taking on new clients. We'd love to hear from you, but if you'd like to find an advisor that's local in your area, both Bridget and I are members of the Alliance of Comprehensive Planners, and you can check out acplanners.org to find somebody who's close to you.
And don't forget to subscribe.